Imagine waking up one morning to find that everything has changed. Stocks plummeting, fortunes evaporating, but some people, hiding in the shadows, get richer than they ever dreamed. What if I told you there was a market crash, forgotten by many, that created millionaires overnight? Stick with me, subscribe, like, and let's uncover the secrets of this financial turning point. The Great Crash of 1929, where risk, foresight, and audacity made some men wealthier than kings. The Roaring Twenties promised endless growth, industries booming, speculators everywhere, money flowing like wine. But behind the smiles and champagne, the foundations were cracking. Many believed markets were permanent, that buying on margin was a safe bet. Yet as prices soared, tension built. By 1929, the bubble was ready. In a matter of days, everything shifted. Some lost everything, others, with prescience or cold strategy, gained beyond belief. This is the story of the forgotten winners in a tragedy remembered for loss. In the years leading to 1929, stock prices in the U.S. soared on credit, optimism, and speculation. Many small investors borrowed heavily to buy stocks. Companies issued shares with little oversight, and general sentiment was that the boom would never end. Economic indicators, agriculture, industrial output, were increasingly mismatched with the valuations. Experts warned, but few listened. The rise seemed rational until it didn't. On Black Thursday, October 24, 1929, panic struck. The market opened with massive volume, people selling shares, trying to exit. Then, Black Monday, October 28, and Black Tuesday, October 29, followed. The Dow Jones Industrial Average collapsed. Prices dropped not just steeply, but precipitously. Many lost everything in hours. But a rare few were ready. Among them, Jesse Lauriston Livermore, the famous speculator. He had positioned himself to profit from a downturn by shorting stocks, borrowing shares and selling them, betting on a drop. When the market began to collapse, Livermore's short position surged in value. According to historical sources, on Black Tuesday alone he made more than 100 million United States dollars in profits, equivalent to billions in today's terms. Joseph P. Kennedy Sr. also played his hand. He sold off large parts of his portfolio before the crash, sensing overvaluation. When prices collapsed, he had cash to buy undervalued assets and also profited from bets against falling stocks. While many were ruined, Kennedy increased his fortune through timing and patience. Bernard Baruch, dubbed the Lone Wolf of Wall Street, had long been wary of speculative excess. In 1927-29 he began trimming positions, shifting holdings into safer assets like gold and bonds. When the crash came, his risk was lower, his exposure minimal. He did profit from shorting and from being liquid. He preserved and even grew wealth while others sank. Clarence Hattrey in London also features in this drama. Though he was not as famous in America, Hattrey's empire collapsed in September 1929 amid fraud and misvaluation. He did not become a millionaire in the crash. His downfall contributed to the panic. But the contrast between those who bet against the bubble or withdrew and those inside it is essential. Livermore's strategy was brutal: to sense weakness and act when most were blind. He watched the margin calls, observed thinning auction floors, heard rumors of bank strain. When the selling began, he didn't hesitate. Thanks to leverage, profit magnified. But also, risk. If the crash had stayed mild, he would have lost everything. This is the double edge of short selling. The crash also revealed weaknesses in regulation, margin rules, and banking. Many brokers had loaned huge sums to speculators. Banks themselves held speculative stock. When share values fell, both individuals and banks were insolvent. But those who had diversified, who held cash or gold, or who were short, could weather the storm and even profit. The market crash was tragic, but also a crucible that rewarded preparation. The general public saw little of those gains. Homesteaders, clerks, small investors who bought high, many lost it all. Many became bankrupt, lost homes, savings wiped out. But behind closed doors, in exclusive brokerage rooms, some celebrated. The crash didn't only create ruin. It redistributed opportunity for those who had anticipated the fall. The moral and material landscapes shifted overnight. How did those who profited know? Several had been warning for months or even years. Baruch, Livermore, and Kennedy noted unsustainable credit growth, overvaluation in sectors like automobiles, overbuilt real estate. Economic signals: falling farm incomes, tightening credit, rising interest rates. But more than data, they had temperament. The courage to act, to stand outside the crowd, to risk capital when others pushed for more leverage. That courage made them millionaires overnight. Some believed they had inside information or secret knowledge, others simply observed patterns and were contrarian. Livermore famously documented in Reminiscences of a Stock Operator how rumor, psychology, and panic accelerate declines. He saw when the market became less about business fundamentals and more about euphoria, an ominous signal. The crash was global in impact. While centered in New York, the tremors were felt in Europe, Latin America, Asia. International banks had exposure. Investors around the world held American securities. When American markets fell, the price ripples spread. Some foreign speculators, or those who hedged, also profited. But many more suffered. The wealth gap in the crash widened globally. Meanwhile, trading mechanisms failed under stress. Ticker tape delays, margin calls across brokers, settlement failures. Some short sellers could close positions early, others were squeezed. Liquidity dried, but those who had prepared, for example with cash reserves, could buy depressed stocks after the crash or hold on to short positions to maximize gains. Those disaster preparations paid dividends. Joseph Kennedy didn't just make money from shorts, he also bought depressed real estate and commodity stocks. When values collapsed, assets that once seemed risky became bargains. He recognized the crash as both fuel for loss and opportunity for accumulation. His wealth in years after 1929 was significantly increased by such counter-cyclical investments. In many accounts, Livermore's gains from short selling in 1929 are legendary. But he also lost much afterwards. The crash gave him the biggest one-day gains in Wall Street history at that time, yet personal life, subsequent losses, and mistakes haunted him. The brilliance of that day contrasts with the sorrow of what followed. Another lesser-known figure. Some speculators in commodities, like grains and metals, who anticipated collapse in demand or overproduction. As industrial expansion overshot consumption, these markets crashed too. Those who had shorted or held options on commodities also made gains. They are less celebrated, hidden in grain contracts and dusty broker ledgers. Wealth kept being transferred in the crash, not just from small investors to big speculators, but from those over-leveraged, those trusting borrowed money, to those with liquidity. Banks foreclosed on properties, investors' collateral was seized, short sellers collected. Millionaires were made not from new industries, but from collapse itself. Emotion ran high: greed, fear, delusion, panic. On Black Tuesday, trading floors were chaotic, cries of, "Sell! Sell!" Walls echoing with desperation. Yet some traders sat calmly, watching the carnage, executing orders they had placed earlier, knowing that every panic sell was their profit. The contrast between chaos and cold calculation was stark. The media both magnified panic and amplified stories of those who lost. Newspapers printed images of ruined investors. But very few front-page stories celebrated those who made fortunes. Today, history remembers the victims. Millionaires of the crash are sometimes forgotten, or painted as opportunists rather than survivors. After the crash, reform was forced. The Securities Act of 1933, the Glass-Steagall Act, and other regulatory frameworks emerged. But many rules were too late for those who had gambled and won, and too early for others who never saw the fall coming. The architecture of modern financial regulation is partly built in response to that crash, because it spotlighted what happens when speculation goes unchecked. The crash also reshaped culture. Distrust of Wall Street, new populist movements, literature of loss and despair, books, poems, plays. But in contrast, there were tales of homes bought cheaply after foreclosure, fortunes made from bargains, and legends whispered in brokers' clubs. Those stories survive in dusty memoirs, not in official curricula. Our forgotten millionaires live in footnotes. The psychological legacy of the 1929 crash still informs how investors today behave. Fear of bubbles, warnings about leverage, fascination with short sellers, and the allure of being the one who profits while others perish. Crashes are remembered as tragedies, but also as opportunity. The duality fascinates and warns. What separated winners from losers was not always intelligence, but timing, courage, liquidity, and perception. Those who made money saw overconfidence, overheated credit, saw the warnings. Those who lost, the vast majority, trusted momentum, ignored risk, borrowed more. The crash became history's harsh instructor. The forgotten market crash that made millionaires overnight is no myth. It was real, painful, brutal, and yet, for some, lucrative beyond imagination. The crash of 1929 did not just destroy, it built fortunes in its downfall. We remember the trauma, but less often the triumphs of those who foresaw ruin and acted. The moral: in every collapse lies possibility. When markets overreach, when speculation blinds logic, when credit balloons, the foundations are fragile. But for those with vision, with courage to step back, the collapse is not only ruin, it's rebirth of opportunity. Yet, opportunity comes at cost. The crash also produced poverty, despair, widespread suffering. Lives lost, dreams crushed. Those who benefited did so in part by others' ruin. Ethical questions remain. What responsibility do winners bear when many lose everything? It's not just about profit, it's also about humanity. And today, when markets soar again, cryptocurrencies, tech stocks, real estate bubbles, lessons of 1929 echo. Don't ignore warnings, don't overleverage, think about liquidity, stress test your beliefs. History gives us more than stories, it gives us maps for navigating tomorrow's storms. If this journey into forgotten millionaires fascinated you, hit subscribe, share this story, and turn on notifications. Because finance history is full of hidden turns and untold fortunes. Next time, we'll explore another crash, one that's been almost erased by time. Stay alert, stay curious.